Crypto is notoriously volatile and DeFi is even more so. So imagine knowing exactly what your crypto yields would be before committing your finances to it. Then even better, when committing, imagine not being asked to lock up your stake for a certain number of days. Yeah, I know, unheard of. Enter Pendle Finance. Pendle Finance is a crypto yield management protocol that offers a fixed yield return while allowing users more control over their staked assets and how they generate rewards from them. To give a quick analogy, imagine you own an apple tree that produces apples every year. Normally, you would have to wait until the apples grow and are harvested to sell them. Now, imagine there is a market where you can sell future apples before they even grow. This market lets you sell two parts separately: the tree, which represents the ongoing production of apples, and the future apples, which represent the yield or the apples that will grow in the future. If you think the price of apples will go up in the future, you can sell the future apples now at a higher price, securing your profit early. Conversely, if you think the price will go down, you can sell them before the price drops, again securing your profit early. Pendle works similarly for yield-bearing assets like your apple tree. It splits your investment into two parts, the principal and the yield. You can trade the yield separately based on your predictions about its future value, allowing you to access and use your future earnings now instead of waiting. But how exactly does this work, and is it worth the hype? Pendle was created by four guys back in 2020 with Tian Li acting as their CEO. At its core, Pendle is a decentralized finance or DeFi protocol that enables the trading of interest rate derivatives by separating the yields from the yield-bearing assets. Pendle is a protocol that allows for the trading of future yields through an automated market maker system across multiple blockchains such as Ethereum, Binance, Arbitrum, and more. The protocol splits the underlying yield-generating token into principal tokens known as PT and the future yield tokens known as YT, enabling users to trade ownership of yields and earn immediate income or exposure to the true yield of the underlying assets. Additionally, Pendle also allows users to provide liquidity and earn additional yield, making it a popular place for those looking for a predictable, fixed yield return rate without the commitment of a locked staking period. But to really explain Pendle, let's quickly break down some definitions first. Let's start with DeFi. Decentralized finance, better known as DeFi, refers to a financial system built on a blockchain technology that operates without traditional intermediaries, offering services such as lending, borrowing, trading, and investing through the use of smart contracts and AMMs. Next, an AMM or automated market maker is a type of decentralized exchange protocol that uses algorithms and liquidity pools to facilitate asset trading without the need for a traditional order book, centralized authority, or a human intermediary. Finally, a yield in crypto refers to the earnings generated from holding or staking cryptocurrencies, typically through interest, dividends, or rewards provided by the DeFi platforms and protocols themselves. But how does Pendle work exactly? As I mentioned, Pendle is a permissionless yield trading protocol where users can execute various yield management strategies for a fixed reward. But to fully understand Pendle, it can be broken down into the following three parts. Yield tokenization. This is where Pendle wraps your yield-bearing tokens into standardized yield or SY tokens, which are a wrapped version of the underlying yield-bearing token that is compatible with the Pendle automated market maker. This SY token is then split into its principal and yield components, where PT is the principal token and YT is the yield token respectively. Next, we have Pendle AMM. Through Pendle AMM, both principal tokens and yield tokens can be traded, further increasing yield and returns potentially for users. Finally, vPendle is a vote escrowed Pendle. To clarify, when users lock up their governance tokens, they receive vote escrow tokens in return. These V tokens typically cannot be traded and are simply used to confer governance rights to their holders. Additionally, on Pendle, a certain amount of time must elapse before users can participate in governance with their VE tokens, ensuring they are more likely to act in the long-term interests of the platform. Functionally speaking, VE Pendle also acts as a Pendle sink, which helps keep the overall health of the network in shape by removing excess Pendle from circulation. So, what exactly makes Pendle unique? Pendle is unique because it allows you to tokenize and use immediately the benefits of your future yield rewards while requiring no locked staking period for you to participate. By giving users access to their future yield rewards, they can further improve their yields, giving Pendle an advantage over some of its competition. Pendle is also very user-friendly, requiring very little to get started and requires very little to be locked up before being able to benefit. Though, playing with DeFi is like playing with fire. Those who know how to use fire wisely will have discovered a useful tool, but those who use fire irresponsibly will only burn the house down, which is just something to remember, not that this is financial advice. The Pendle token can be used for all the classics like payments, staking, and governance. The current total supply of Pendle is roughly 258 million Pendle tokens. However, due to the inflationary mechanics of the network, this number will increase at roughly 2% per year from 2026 onwards. At launch, the initial token distribution was as follows: 65% made up the circulating supply, 19% went towards the ecosystem fund, 10% towards incentives, and the final 6% went to the team. So, is Pendle worth all the hype? If you are into DeFi trading but would like a more steady and certain fixed yield position, then Pendle might be of interest to you. Allowing you to use future yield before you have received it as additional leverage to increase your current yield is a very tempting feature for most traders and one that is likely to see the platform drawing new users for as long as the crypto bull run stays active. The fact Pendle allows you to do this without requiring a fixed staking lockup period is also fantastic from a consumer perspective, although admittedly does raise a bit of concern should any fault in the network's code be discovered. That said, overall, Pendle seems like a solid platform, or at least as solid as any platform can be that is involved in DeFi yield trading. Assuming there are no major mishaps in management from the top and assuming there are no issues discovered within Pendle's code, it seems likely that Pendle's best days still lay ahead. Though, as always, nothing is ever guaranteed in crypto, of course. Thanks for watching. If you like to know how to create a Pendle wallet, check out my article in the description below.